Welcome everybody to another exciting edition of Markonomics 101 Hoot Loot, the place to be informed, not misled, and where you get education, information without fabrication. Today's show is about walking off the cliff. Are we doing it as a market? It sure seems like it, and it's awfully cold up here. Anyway, I'm gonna make you nice and sober and cold in just a couple minutes here. So we're gonna go to the first chart, which is of the Dow Jones Industrial Average, which is normally where we start. The Dow has had a a pretty good uptrend for this period of time. The thing about it though that upsets me or that bothers me is that you've got this going on here, and this is something that really needs to. There's a high here, and a lower high here, and a lower high here, and I'll tell you, that is a sign of trouble. Now, there's no reason that this could not rally back up above this high right here. If it did, then all bets are off. Then I'm wrong. But right now, this looks to me like a market that is losing momentum, losing strength, and the Dow is showing it, even though it's close to its highs. So, with that, let's move over to the Nasdaq 100. The Nasdaq 100, same kind of thing going on with it. Really still a nice uptrend. But again, what bothers me about this Nasdaq 100 here is again a top here below a top here. Now, if this should rally above here, okay, then again, my premise is not accurate. But right now, I would be watching out for the fact that this has made a failed high, and it's October, and those are not good facts. Okay, so let's go on. We'll go on to the Standard & Poor's. Yeah, as a matter of fact, October has been very, very not kind to stocks. And wouldn't it be ironic if this October turned out to be one of those not kind to stocks kind of months? So you just never know. Standard & Poor's, same kind of thing. I'll go over this like real quick. But basically, you got a kind of a decent line here. But again, a top below a top. And that's just not a good sign. So let's move on. This is Apple right here. I like to include some of the bigger companies that make up most of the capitalization of all the exchanges because they're so influential. Apple also has had a nice uptrend, but again, it's got this. And what I don't like about this is that, shoulders a little bit, but again, we'll see. Its earnings are going to come out, and it's either going to go one way or the other in a big way. All right, so let's go on to Amazon. Amazon really looks bad. I can't come up with a chart that looks any worse than this right now for the market. That's a market chart right here. I mean, right there. This is a head and shoulders, a picture perfect head and shoulders right there. And, it's got support right here, about 2,900. If it falls below 2,900, that is a really bad sign. And yes, Amazon could rally above 3,400 and negate this entire pattern. But this is normally not a pattern that is conducive to further rally. This is a reversal pattern. So I'd pay attention to these, and the market is full of these all over. So you got to pay attention to the fact that a lot of these companies are doing the same exact thing. All right, next one is Facebook, which is also same kind of pattern. Again, we've got a kind of a head and shoulders here, with the neckline here, and again, head and shoulders right here. And it rallied a little bit today, but again, it's not that much in the grand scheme of things. Facebook does not have a good pattern. It's already broken. It's if it had its trend line was broken a while back here. So the pattern got broken here, and now it's in a head and shoulders. So this is not one that augurs well for the market at all. All right, Google, same thing. Alphabet soup. Here you go. Basically a head and shoulders type of formation here, and with the pattern having been broken, here's the uptrend. It kind of looked like this, and it was broken. Broken here. Now we're trying to, we're making a rally failure right here is what it looks like to me. And I would say that, we would look for support somewhere around down here, probably on Google. Okay, so let's go on. Microsoft, again, another major company. Look at it. Again, same pattern. I know I'm being repetitive. Oh, excuse me. So cold here. Okay, in any event, this is Microsoft. Notice again, same kind of pattern. I mean, I hate saying it all the time. But I do say it all the time. This one sucks. So be careful of this. This marks a big weight in both the Dow and the NASDAQ 100, and it's just really a dangerous looking one. Here's Tesla, everybody's favorite company. Tesla, you know, actually doesn't look so bad, or didn't look too bad. It's kind of got this going on. But, you know, it had earnings today and went up a little bit on them. Supposedly a great earnings report. I don't know. I would not hold Tesla here. I just wouldn't take a chance on it. There's just too much that can go wrong. So we'll see where it goes. I still think it's going to break down, not up. Okay, this is the dollar index, and I think this is one of the more important things I'm going to talk about today is the U.S. dollar. The U.S. dollar and interest rates are doing some really strange stuff, and that's part of the whole story of today is interest rates, the dollar, and financial companies. In this case, what you'll notice about the dollar, and I've talked about this a little bit in the past, it made sort of a rounded bottom here like that, and it's sort of now in a consolidation here. Now, what it looks like to me, normally a pattern like this is a bullish pattern, and so you would expect to see a breakout above. I just don't know yet because we've got other things that are going on in the marketplace that I want to talk about. This is one of them. Okay, this is the 5-year Treasury rate. And now you're starting to see something that is so important that I cannot overemphasize this at all. Okay, interest rates are going up. That is a big deal. Why is it a big deal? Because they're so low. If you look at the 30-year rate, okay, the 30-year rate has gone up like 50 basis points in just a few months. Now that's a lot when you compare it to the fact it's about 1.5. So, you know, we're talking about a huge percentage move. Now in this case, the 5-year is just still sort of like bottoming out, but what you notice is it's bottomed out and it looks like it's coming up. Now, more important than that though is the 10-year, which we're going to show you now here. The 10-year is also, it's trading at a level that is higher than it is traded at in months. I mean, this is a record level for, you know, several months. It just basically went back to that area right there back in June for a couple days, and that was about it. Now, if we go to the 30-year, okay, the real long rates. Oh, bless you, Ace. Yeah, Ace is really very he's very particular about the 30-year, so it's okay. So anyway, the 30-year, now what you'll notice about the 30-year here is that, now check this out. I mean, look at how much this thing has rallied toward the end, and it's really made a kind of like, it's kind of like come out of like sort of a, almost a triangle with a saucer bottom formation. This is really bullish for rates, but it's bearish for everything else. And I want to make this really clear. When, when rates go up, okay, rates up, everything goes down. Okay, that means that stocks go down, bonds go down, everything that is priced in cash flow. That's how you value things. The higher rates are, the more that the cash flows from it are discounted, and therefore the less the asset is worth. In addition, stocks compete with bonds because of their yields. Bonds have, interest. Stocks have dividends. They compete with each other. Once interest rates starts going up, then stock prices have to go down so that their dividend yields become competitive. That's how it works. And it can come in a hurry. And the reason I'm making such a big deal out of this is that this could happen while our financials are in trouble, while the stocks are cratering. There's a whole lot that can go wrong here. So let me continue on. Okay, now this is gold, and I'm going to just spend a couple minutes on gold because even though I've kind of vacillated on it, right now it's actually looking pretty good. I think I think gold right now is probably at a good entry point. Not quite yet. This weekend we're going to give you some ideas because I think gold and or silver are actually going to start moving positively. So this weekend we're going to talk about that, but we're not going to talk about that right now because right now risk mitigation is more important for you to appreciate. It's taking your money off the table before it takes it off of you. That's the important thing today. Okay, this is silver AGQ, and one of the things I've noticed about it is that it's held this trend line very well. It could easily be taking off. It could easily also break down here. So it's a little too early to do anything, but these are looking good, especially with the dollar looking bad. Okay, now here's where the damage really is. It's the financial companies. I've been talking about them before, but look at this. This is American Express. I mean, this is one of the blue chip companies had supposedly with good earnings, and look at this thing. I mean, it's literally it's starting to curl over, it's starting to fall apart here, and this thing is, highs below highs below highs below highs. It's in a downtrend, and this is going to lead the market lower, and that's the thing that scares me. You cannot have a healthy market with an unhealthy financial sector. And not only are they unhealthy, but interest rates are going up. And with interest rates going up, you have no idea what the impact on these banks is and these financial institutions. They could be so unbalanced in their positions that an interest rate move could just absolutely devastate them depending on their leverage. I don't know which ones it would impact, but that's why it's of concern. All right, so now we're going to look at Bank of America. And Bank of America does look, make Bank of America great again, would you? But it doesn't look very good either. And I would say this is another one that it just scares the hell out of me. And with interest rates going up and all these leveraged plays and bad loans and loss provisions and all that, we just could be stepping into some kind of, horrible, shivering, nasty cliff. That's all I can say. All right. Berkshire Hathaway, I've talked about this a number of times. I think this is about as much of a bellwether as there is. It still is in its head and shoulders pattern though. Still hasn't broken out, but it's kind of extending it. But I'm telling you, breaks down here, we're looking at potentially a real problem. I wouldn't be too surprised if we had a financial crisis upon us, because there's so much going on that has not yet been resolved, or the market has not dealt with, that is so out of equilibrium that it could just happen in one big swoop. So just be careful. This is another one today that broke down. I haven't talked about in the past. Goldman Sachs, the also known as Government Sachs. But look at this. Look at this company here today. I mean, this is probably what investment banks are very influential in addition. Look at that day today. Big down move. Biggest down move in the Dow today was Goldman Sachs. You cannot have companies like this breaking down, JP Morgan breaking down, American Express breaking down in a healthy market. So we've got one last one here, and that's Morgan Stanley. Morgan Stanley is also, look how unhealthy Morgan Stanley looks. It again is one that I would say, right there is sort of the Maginot line to Morgan Stanley. It's got a rounded top, and that's not looking too good. So the message today is watch out for that cliff. You're about to go off it. You may go off of it, but come to Markonomics 101, hoot loot, be informed, not misled, get the real truth before the media tells you the real non-truth. I'll talk to you next time. We're going to have another filming this weekend, hopefully not on such a cold cliff. See you guys.